Sovereign government issuers are distinguished by their legal authority to tax economic activity versus corporation generating revenue from their businesses. So the way to see this is that rather than a business generating revenue, main source of revenue from government are tax income. Additional sources of repayment is the repayment of debt, tariffs, usage fees such as road tolls, and cash flows from government-owned enterprises. So for the government-owned enterprises, the revenue generated is same as the revenue generated from normal businesses. Government get their revenue from tax income rather than generating revenue from businesses that are selling goods or offering services. Before we look more into sovereign debt, we first look at the differences between developed markets and emerging market sovereign issuers. Government issuers can be broadly categorized under developed market and emerging market. For developed market, countries are generally stronger and has more stable and well diversified domestic economy. The economy is able to generate tax income because this economy is stable and well diversified. The tax income that comes in is very stable, and so it makes it easier for government to craft its fiscal policies. These fixed income securities that are being issued are mainly denominated in major world reserve currencies, such as the US dollar and the euros. Because of the above positive features that we talked about, developed market government is able to have unconstrained access across various maturity periods, which means that they can easily borrow short-term, medium-term, or longer-term. Whereas for emerging markets, they are generally less stable, but they have higher economic growth. But this is coupled with greater volatility. So for developed market, they have lower growth potential, normally like 1 to 3%, but emerging market has a higher GDP growth, and that is like around up to 7 to 10%. But it has a higher greater volatility. The reason why we keep talking about economic growth is because the higher the GDP is, the more tax income the government is able to generate. But even though emerging market has a higher GDP growth, but it has a lower GDP overall. So the tax income from developed market is still a lot higher. Emerging market is often dependent on dominant domestic industries, and these are normally low cost and low tech industries. For example, it could be coffee plantations or textiles industries. Emerging market government spending may involve expanding economic and social infrastructure, and these exceed the domestic tax cash flows. So giving rise to having to borrow from external or supranational funding. Supranational funding is funding like borrowings from international organizations such as the IMF and the World Bank. Sovereign debt securities are often denominated in restricted domestic currencies. So these domestic currencies could be restricted. For example, the Chinese yuan is a one good example. And they have a limited convertibility due to the illiquidity of the conversion. So even if there are no restriction or legal restriction, the trading of the FX could still be illiquid due to the low volume. And this will discourage foreign investors from buying domestic currency sovereign debt. External debt held by supranational or foreign investors are predominantly denominated in foreign currency for the reasons that we stated before. So examples include Romania's euro-denominated bond, So these bonds are denominated in the euros currency, and the PT Indonesia Infrastructure Finance US dollar denominated bonds. When foreign investors invest in these foreign currency denominated bonds, they do not have a direct currency risk with respect to the domestic currency, but they will have indirect currency when they buy these foreign denominated bonds. Because at the end of the day, the government would need to be able to generate these foreign currency revenues to be able to pay off the foreign external debt. And these revenues are generated through international capital flows and trading in goods and services. A country's fiscal policy is determined by the level of sovereign debt, government spending, such as budgetary requirements. Budgetary requirements is a result from the policy. That is how much the government is planning to spend and how much revenue they collect from taxes. They will need to borrow the differences. And also existing debt service costs and future debt service costs as well, which are the interest and the eventual repayment of the risk-free interest. Revenue sources are tax receipts, fees like the usage fees we talked earlier, and income from government-owned enterprises. For the budget, if there's a deficit, it means that the spending is more than the tax income or other forms of income, they will have to need to borrow. While surpluses will reduce current borrowing and could be used to repay existing debt. So for government debt management, government can choose to issue debt in different maturities. For example, short-term, medium-term to long-term. So the management is about deciding what is the composition of short-term, medium, and long-term securities. For short-term securities, these are fixed income securities that have maturities ranging from 1 to 12 months. So these are a year or less. These are also known as T-bills, treasury bills in the US. For medium and long-term securities, these are often referred to as treasury notes. Treasury notes are fixed income securities that have maturity that are more than a year and less, at 10 years or less. And the rest of the longer terms are known as treasury bonds. The most common form of government debt are fixed income coupon instruments denominated in their respective domestic currencies. But that doesn't mean that they do not have floating rate or inflation-linked bonds or other types of bonds, but that the fixed rate are the most common. Rather than issuing these securities, government can also guarantee some of these other securities, which makes them kind of similar to sovereign debt. For example, in the US, we have mortgage-backed securities, and some form of mortgage-backed securities are guaranteed by the government. We shall talk about this later. Given the authority to levy taxes, national government typically represent the lowest default risk among domestic currency issuers. So these other domestic currency issuers are other domestic corporations. Because the power to levy tax across corporations and citizens across the whole country is a very powerful way to generate tax income. And they are generally the primary issuers because of their large-scale borrowing needs to run the country.